Here for more on the May jobs report is Jason Sorens. He's a senior research fellow at the American Institute for Economic Research. Thank you for your time today, Jason.
Good morning.
Talk to us about the perseverance of the labor market and how it's outlasting inflation and interest rate hikes while consistently creating jobs.
Yeah, this is a resilient labor market. Steady is the word for it. This is a sort of normal jobs growth number. And we've seen that the market reaction has been positive. When we look at market expectations of Federal Reserve rate cuts this year, we've seen a decline in both expectations of just one rate cut and expectations of three or more. So basically, the market is saying, there's not going to be a recession this year, or at least the Fed is not expecting that there will be one. And so we're going probably to get two rate cuts this year. And so overall, it is a positive jobs number.
That's good news. And yeah, the job creation wasn't broad-based. In fact, as many industries added jobs as cut them. So what sectors are overperforming right now?
Well, you mentioned healthcare. Healthcare was the number one adder this month. And federal government, they're down 59,000 since the start of the year. So we're seeing, in general, the service sector is doing well. So we've got a large economy, and really the most positive number I would say from this month is the earnings growth. So we saw earnings rise by 0.4%, which is a good number for just 1 month.
Well, very good, yes. And unemployment was mostly the same in this recent report, but the labor force as a whole shrunk over 500,000, and the participation rate dropped a tick. What insight do these metrics give you about what's under the hood of this economy?
Well, we do see an aging workforce, and so over time, the tendency has been slightly downward in labor force participation rates just over the long run. We've also seen that the labor market is declining because of immigration enforcement, so we should expect that to continue. So the hope is that we can turn around labor market participation rate and get more Native Americans into the workforce to keep our economic growth going.
Okay, Jason, and the Fed has largely taken a wait-and-see approach to rate cuts. It appears likely the Fed may not cut rates in its next meeting. Maybe that's not exactly how you're reading this, but how is the Fed interpreting this recent data and any concerns about inflation?
Their next meeting is in 12 days, and the market would be very surprised if they made a cut at this point. I think the Fed wants to see inflation stay consistently at or below target for 4 or more months, because we've had moments, a couple of years ago when we saw core inflation drop below that 2% target for a month or two, and it was a false dawn, so to speak, on inflation. So they want to be sure that inflation doesn't pick up. They want to be sure that we don't see the tariffs ratchet up again, because that could cause a short-run bump in inflation.
Okay, Jason, can you explain a little bit more about what this jobs report means for Wall Street and also for Main Street?
Basically, it's a steady as she goes jobs report. It's overall a positive sign because there have been some fears that we would start already to see some of the impact of tariffs on the economy. Overall, tariffs are much lower now than they had been announced after Liberation Day. So I think the market is breathing a sigh of relief. And overall, this is a positive number. Hopefully, we'll continue to see productivity growth from innovations like AI, and that will continue to buttress the economy this year.
Yeah, and as we've been covering here, the wage pressure is ticking up a little bit. Can you expand on that a little more?
Yeah, so we don't know if this earnings growth is a result of inflation, right? So that would be the downside if this is wage growth that is a result of price growth or partly contributing to it, or is it a result of productivity, right? So that would be the positive side of this. If workers are becoming more productive, and that's the reason they're seeing rising wages, then that is a bullish sign for the economy. So we'll have to see what the next inflation number is, and that will tell us a lot about what's really going on here.
So any thoughts on how investors should be interpreting all this?
Yeah, so I think investors can slightly reduce their sort of tail risk fears about the economy. Now, it's certainly not, we're certainly not out of the woods, because typically employment reacts to the underlying economic fundamentals with a lag, right? So unemployment actually peaks after a recession is over. But overall, this is showing us that we're not going to see an immediate significant hit to the economy. So it's another reason to be a little bit more comfortable about investing right now.
Understood. Well, a very detailed look at this. Jason Sorens at the American Institute for Economic Research, thank you.
Thanks for having me.